Good afternoon, everyone, and welcome to our latest webinar looking at all of the things that you need to think about when you are a digital or cross-border worker and understanding all of your tax implications and all of the little nuances that can be quite challenging to understand. For those that don't know me, I'm Mark McAllister. I'm Senior Partner for HOLBORN based here in Cape Town. And I've been helping international clients that are globally minded provide all these kind of solutions for the last 6 years. So please feel free to connect with me on all of the social media channels that you see listed on screen today. You get the latest updates on investment trends, tax efficient solutions and offerings for people just like you. So the structure of today's presentation is as follows. We're going to start off with a bit of an introduction, covering who this webinar is actually for, before I introduce our main speaker, Jeneen Galbraith from Galbraith Rushby. There'll be a Q&A section at the end. Feel free to ask any questions along the way using the Q&A button at the bottom of the screen, and we'll do our best to answer them all together when we get to the end. So thank you very much for taking part. All right, so the question is, who is this webinar for? So are these the kind of thoughts that are running through your mind? You know, are you currently abroad, but you're thinking about going back to South Africa soon? Do you plan to carry on working for your employer remotely when you get back to South Africa? Are you not sure if you can still be employed or not? You know, you're not sure whether potentially this will involve some form of a subcontracting or a self-employment arrangement. You don't know where potentially to get started. Do you want to know how to protect these foreign earnings in pounds, US dollars, euros, etc., and in the same time frame try to legally mitigate your tax position so that you only pay unto Caesar what is due to Caesar, wherever that tax authority is around the world? And are you aware of all the legislation that you should be thinking about? So if any of these questions ring true for you, then this is the webinar for you to understand a little bit more about your options. So what are the questions that we often hear linked with those sort of needs? Well, one of the big ones is, you know, what is a dual tax agreement? You know, how do I live in South Africa but work remotely as a digital nomad? Who do I pay tax to? Who is it liable to? What are the implications for my employer? And if I should do it, should I incorporate? And if so, if I become a contractor, where should I be? If I consider this option, you may have heard of it or may not have come across it before. How do I use a foreign agency? How do they work? And then ultimately, how do I plan all of that in for my financial future so that I am secure as possible in this beautiful country, if that's where you want to be? So a little bit about us. We've been around since the late 90s. Today, we're the second largest independently family-owned financial advisor in the world. We've got assets under management just coming up to around the $3 billion mark. We've got 18 offices servicing about 20,000 clients globally. And where have we grown from? Well, really, it's looking after expats and globally minded individuals, probably just like yourself. Why do people choose to do business with us? Well, firstly, the size. You know, that size and longevity in the market gives us scale and the ability to offer these kind of solutions and other ideas that you may or may not have come across before. We're also completely independent. So one of the things a lot of my clients love is that we're not owned by or incentivized by any fund or provider, so we can work with complete impartiality wherever we want to around the globe. But the main reason why I think people will use HOLBORN and provide us with so many recommendations is because of how well we look after our clients. We're very proud of winning our industry Oscars consistently. We've just won 6 awards. We won 8 the year before, and as you can see, regularly winning in the category of service. We're also very educated in what we do. All of our team, myself obviously included, are educated globally by the London Chartered Institute of Securities and Investments, but also doing all of our qualifications globally in the jurisdictions of which we operate. And finally, safety and security. So all the solutions that we recommend will be the safest in class, and we predominantly use solutions and structures where the government will also put a form of guarantee on your capital so that you know that your money is safe. What kind of solutions do we offer? Well, you know, a whole range, a whole suite of everything from pensions and trusts, offshore companies, billing arrangements like we might be talking about today, platforms, offshore property, offshore mortgages, UK lending as an example, citizenship by investment. So if you're watching this and thinking, how do I get another passport to move around the world a bit easier? We do that as well, along with a range of alternative assets. And we do that from a number of different locations around the globe. Obviously, myself and my colleagues here in South Africa, we've got offices in Cape Town, Joburg, Durban, the Winelands, and now further out in Africa, Mauritius, and just literally this week, Namibia as well. So rapidly expanding, but also with a footprint across many regulated markets through the likes of Europe, USA, Hong Kong, and UK, to name but a few. Okay, well, enough about us. Let's move on to introducing our speakers. I'm very pleased to be joined today by Jeneen Galbraith. Jeneen is has an extensive career history working for PwC in the UK and has been in practice back in South Africa for the last 16 years. She has personally assisted many of my clients who have returned from overseas, and our team are always professional, responsive, and super helpful. She's my go-to tax consultant for expats and digital nomads. So Jeneen, welcome. Thanks for taking your time out of your busy schedule. How are you today?
Thanks, Mark. All very good, and glad to be here with you talking to everyone.
Excellent. Great stuff. All right, well, let's get started on the main content today. I'm going to go through a number of points with Jeneen, and Jeneen will be sort of giving her view on it as the professional. So a combination of both financial advice and tax consultancy all in one webinar. So what's the first thing that you need to be aware of? Well, you probably heard about this thing. So Jeneen, dual tax agreement means you shouldn't pay twice, but you still owe a government somewhere. You can't just not pay tax. Is that right? What should we be thinking about when it comes to a dual tax agreement?
Yeah, definitely, Mark. I mean, the dual tax agreements, the DTAs, as we refer to them, are very useful, and they do provide us with a lot of tax relief. But I suppose a couple of points is it's not always perfect. Because you've got different rates in different countries. You know, for example, in the UK, you've got your 40% maximum. In South Africa, we've got 45% maximum. The UK tax-free threshold of 12,570 works out to a whole lot more than our South African tax-free threshold at about 86,000. So sometimes there's a little additional tax to pay somewhere along the line. So we have to do the calculations and the numbers just to be aware of it. It's a good starting point, but it's not necessarily perfect.
Absolutely. And I think one of the points here that I don't get it as much as I used to, but I think there was maybe a belief that you could hide away from the tax authorities and what they didn't know didn't hurt them. But there's this thing called common reporting standards, right? That's a big data sharing agreement. So there's not really anywhere to hide anymore. Anything you want to add on that?
Yes, exactly. And where I'm finding this coming through is obviously through the banks. The minute you put your foreign mobile number, let's say you record that, you put a South African number with your UK bank accounts or vice versa, suddenly information is being exchanged with the local tax authority. They then sharing that information behind the scenes, and then you can get a request from either SARS or HMRC or wherever you are to to query your foreign bank accounts and the earning that's coming in there. So it's definitely a situation where you need to make sure that your affairs are in order, because you just don't want to be caught not declaring your taxes properly. The world is just becoming smaller, and obviously after COVID, we're seeing a complete increase in the sort of drive from the local tax office to get revenue and to make sure that everybody's submitting their returns and are compliant. And they've actually in South Africa at the last budget speech, they actually said that they're going to be concentrating on high net worth individuals who've got foreign earnings. So It's an area of focus. Yeah,
very good, very good. Okay, but it's not all bad news. One of the things I'm a big fan of promoting is the good news stories. So South Africa, for those that don't know, is one of the most tax efficient jurisdictions. If you've worked abroad and accumulated a pension structure outside of the Republic of South Africa, and that you can actually benefit from a 0% exemption when you come to retire if you're structured correctly. So it's not all bad news. But let's move on then. And really, this is why we're all here. I said the majority of people are here. You know, how do I live and work in South Africa, but for an overseas employer? And why is it becoming more prevalent? Well, we're using the technology right now. You know, Microsoft Teams and Zoom, etc., has just risen up and up and up, and more people are using it every single day. So my view on it is, look, try and run your life like a business. And how do you make a business profitable? Well, you drive more revenue. So you try and build more or sell more things, whatever it is that you do as a business, and you cut your costs. So as a digital nomad or somebody that's working overseas, you can maintain maybe a higher level of income overseas, but have a lower South African cost basis. So effectively, you're more profitable, or in our personal lives, you have more disposable income. So a lower cost base and potentially a higher income. And that's why it makes sense to look to do this, and why I'm so supportive of all of the community. But this is the conundrum I'm sure that most people are sat in at the moment. Maybe you're an employer, or sorry, an employee right now, and you're not sure about, becoming an independent contractor. What does that even mean? How would you go about it? So let's just go through some of the questions that I often get posed to me by people, that I've spoken to, even some in the recent weeks about this. So is staying on the UK payroll an option? Okay. What stops this, and after how long? What about things like pension benefits? What would anyone really know? It keeps coming back to that sort of common reporting kind of scenario. And what if an employer has other employees in SA? And what are the labour implications or labour law implications for a foreign employer? And what we'll do is we'll go through each of these scenarios in a second and just talk it through. On the independent contractor side, though, if you're sat there thinking about that, well, the first question you've got to ask yourself is, will your company accept invoices for your services? Okay, will they accept an invoice for your service? If they do, then they're a willing employer. That's the first thing you need to cross a line that I'll show you in a minute. And do you wish to work for more than one employer? Some consultants and digital nomads want to work for more than one client, and so therefore being a contractor does make sense. And these days, a lot of people are being paid in multiple currencies, so in different jurisdictions. So trying to convert that might be quite challenging. So in all of those situations, it potentially makes sense to think about some kind of contracting route. So this is where, Jeneen, you really start to come in. Go for it. Go for it.
Sorry, just a quick one. I think we've got a black box blocking our slides here. We're getting some comments about that. So maybe we'll try to sort it out. There we go. Yeah. So let me just go back to your slide there on employment versus independent contractor. So basically, in a nutshell, an independent contractor is a very, very tax efficient way for people to earn income and to record their taxes in South Africa. It gives you the ability to make a lot of deductions, tax deductible expenses. Whereas employees are obviously much more limited in what they can deduct against their income. An employee, for example, can deduct home office expenses, but what we're seeing from a SARS perspective is that they really are wanting to scrutinize those expenses and deny them as much as possible. But an employee can also claim for like rent or depreciation on computers and things like that, but much more limited than, say, an independent contractor. So one of the things that I'm seeing a lot of is that people are coming over and they're saying, well, the UK company, for example, will allow the employee to be an employee and remain on the payroll for about 6 months. I'm seeing that. And then after that, they want them maybe to go to an independent contractor if they will actually allow that. And the double taxation agreement allows for a person to be in South Africa for less than 183 days. And if the employer's in the overseas, let's say not in South Africa, and they also don't have a permanent business establishment here, then that first 183 days is not taxable in South Africa. The problem, of course, is that if you're coming to come for more than 183 days, and the wording is it's 183 days in any 12-month period. So often there's a little bit of confusion around these 183 days. And if you're going to be here for more than 12 months, then even if you're not a tax resident, you are taxed on your South African sourced income, which means that employment income is taxable in South Africa. So whether you're an employee or an independent contractor, the independent contractor obviously allows you to claim more expenses. So that's where it's advantageous. But just go back to your slide there, Mark, you had a few other questions. I just want to make sure I've covered all your questions. The employment one.
Sure.
Yeah, let's just go back to that. So the how long, I mean, you can basically be an employee forever if your company, your foreign company, will allow that. But of course, the minute you're working, well, let me say, not say the minute, let's say excluding the 183 days. If you're here for less than 183 days and you meet the terms of the double tax agreement, then it's not taxable. But as a non-resident in South Africa, you taxed on your South African sourced income, which I think we'll talk a little bit later, given that slide later. Yes, do they have other employees in South Africa? So when there are other employees and there's a representative employer in South Africa, that's when an obligation arises on your employer to withhold PAYE in South Africa. And that is something that I see foreign employers don't want to get into that space. And that becomes a blocker to them wanting to have you on the payroll, and then they would prefer to have you as an independent contractor. So you've just got to know, there's a little bit of a thing there, and often we have to do a letter, or for the employer to give them comfort as to whether they are a representative employee or not. So that speaks into your labor law implications. Absolutely. And of course, there's more, that's the tax side of things. Of course, there's also labor law implications, which one has to consider.
Absolutely, yeah. And I think one of the things I just wanted to touch on here around that is trying to, there is no one size fits all, is there, Jeneen, around am I tax resident or not? And and there's some guidance in legislation. So the main one that most people have come across or Googled is physical presence, and that's important. Yes. That's where there's sort of the 6 months bit comes in, and once you go over that, you're starting to show that you're in South Africa the majority of the time. But for example, someone like me, I'm a Brit, so I've come down here for work. I'm a non-South African citizen. For me to be deemed South African tax resident, in theory, I have to meet all three of these tests. So 91 days in the current year of assessment, whenever that is, 91 days aggregate each year, so an average effectively over 5 years, and then a total of 915 days over the previous 5 years. So that's what would kind of be for the Brits that maybe, as an example, non-South Africans, I should say, that's something they might be thinking about. But this other point here, and this is where it gets a little bit woolly, right? It's difficult for us to say anything, on an individual basis, obviously, but the principle of ordinarily resident. So this goes back to some case law in the early 1900s around, returning South Africans that come back here after their quote marks international wanderings. So you maybe gone off to the UK in the early 2000s, you've been there for 10, 15, 20 years, but then you come back to South Africa. Is there maybe an argument that they're going to become South African tax residents sooner?
Yeah, so let me just quickly deal with this, Mark. So the ordinary residence is actually your first test that you do, and it actually supersedes the physical days presence. But as you correctly point out, most people that don't have a SA citizenship or ID, they're going to fall under the physical presence until they exceed those 6 years. But we've just got to be aware that SARS could look at your lifestyle and say, actually, you've made your life here in South Africa. You became a resident from the time you landed, basically. Now, it's unlikely that happens, but it is a possibility. So we've got to consider both tests always, and make sure that nobody has triggered ordinary residence before physical presence. And there's a recent court case that just got won in the UK, and it dealt with the double tax agreement and the tiebreaker rules. And those tiebreaker rules look at where you have homes. Do you have homes in both countries? Where are your vital interests in both countries? Where are you habitually, looking at it from both perspectives? It was quite an interesting case, and the courts went very, very in detail into the person's life. And in fact, in this particular case, although the person actually spent more time in the UK, possibly had bigger businesses and wealth in the UK because of family generational, passing down. But because their wife actually was also sick and died, that also required them to spend more time in the UK, and the children were going to school there. But the court still held that they were actually exclusive residents in South Africa. So that's a very interesting case, and will help us to get guidance going forward as to how we determine where a person is resident.
So I think that the message through a lot of this presentation today will be, there is no black or white answer for a lot of the questions. Somebody might seem like they've got the answer. It might be slightly different for the next person that comes along, and that might be for some reason they're not aware of, things like those physical ties and what have you. And by that, one of the things they look at is the guiding principle of intent. What was your intent in what you did? So if you're selling everything up and coming back to South Africa, what is your intent to be back in South Africa? Where's your burial plot? Where do the kids go to school? All those kind of things can show intent. So that's quite interesting.
And
okay.
I think you made, sorry, one more point there. The important point I think also that you do make there is that you don't necessarily become a resident the minute you land in the country. And so it's important to deal with it rather than bury your head in the sand and sort of think I'll deal with it some point down the line, because you can actually get your affairs in order before triggering residency, and that's the important point,
Absolutely. So one of the things that we've done here is we've put the options now, so split them out. So there is quite a few different options. So we've talked about one already, which is being employed. So an employee, you're on the payroll. So you might be in the UK at the moment. You could go and work for the South African subsidiary of the same company. They might put you on the South African payroll. It's probably likely that you'll be on one or the other, sorry. But what are you going to pay? Well, your tax is going to be automatically deducted under PAYE, which stands for pay as you earn. Okay, all of that's covered within the dual tax agreement. So it's a pretty simple way of getting most of the way where you need to. But there might be a risk of a small liability, and we'll come on to the tax tables in a minute. As Jeneen rightly said earlier on, things like the £12,570 personal allowance could potentially cause a small liability. But so being employed is an option. You could do that in the UK or South Africa, but there are issues to be aware of. What I think a lot of people are waiting really to hear is that there's this dotted line where you cross over into becoming a contractor of some description, and how do you do that? What's the best way to do it? So scenario C and scenario D here are where you're personally a contractor or self-employed. So you're raising invoices from yourself as the individual. Obviously, and correct me if I'm wrong on this here, Jeneen, the tax must be declared and paid by you to the authority that you're reporting it to.
Correct.
So you're back here in South Africa, you're raising your invoices. Those might be in pounds, but in theory, that's foreign income. So that should be on a South African return in theory, unless you're still UK resident. That's where the blurry line would be. And there's a risk of a significant liability if you don't hold back money to pay the taxman, right?
Yes. So Mark, just on that one, your tax liability as a non-resident even would fall into South Africa. So whether you're resident or non-resident, because you are non-residents are taxed on their South African sourced income. And what people don't often understand about source is that it's not necessarily where the contract is signed or where the money is paid or the currency or the bank account in the UK. It's the fact that you're sitting at your desk generating that income whilst you're in South Africa. So as a non-resident, you are generating South African sourced income, and you need to declare it. And that, as you say, is the big hole where people often don't realize that.
And I've seen it happen a few times where people, again, it comes back more into that sort of, oh, well, I've earned it, so I'll spend it. And this can happen regardless of wherever you are in the world. If you're a self-employed individual, you have to make sure that you're factoring tax into your cash flows, and that you don't overspend, as it were. Okay, so moving on then, the next scenario really, so E and F would be to create a company somewhere around the world. So the obvious ones that stand out are the UK or South Africa. And this is where things start to change, right, Jeneen? So now we've got a company that's a separate legal being, isn't it? It's a separate thing. So tax is now levied in the company, and we have to pay corporation tax. And if we want to get the money out, we can either, pay ourselves a salary and pay income tax on that, or it's a dividends tax, right?
Yes, correct. So let's just start with the option of a UK company. With that, I do have quite a few clients that I help with those, with looking at their UK tax and their South African tax. But the important thing to note is that if you own more than 50% of the shares of that UK company, you start falling into what's called controlled foreign company legislation. And that's not good, because actually it takes the profits of that company and it requires you to put them in your tax return in South Africa. So what you really have to do is have that company set up, say being owned by a trust. That would solve your controlled foreign company rules. And that can be a very good structure. You've got to look at you can do that. The other option is to have a company in South Africa. And often I don't necessarily advise companies in South Africa, because you are now having another legal entity that's got to do tax returns, you've got to do financial statements, there's a whole lot of administration around that. And basically your top company tax brackets are your 28% plus a further 20 odd percent. So you basically get to 42% tax overall in a company. You know, so you're looking at our top brackets of 45%. So it's not a whole lot of difference. So you've got to weigh up the administration costs, and are there other benefits to having a company, basically? Maybe corporate identity, you know, risks are ring fenced into the company. If all those things are good boxes for you to tick, then having a South African company is another way of obviously trading, and that company invoices and then you take a salary.
Absolutely. Okay. And then the last one, this is one that's relatively new. I mean, I know a number of people have come across this before and are on the call because they utilize this kind of structure. So using an agency agreement outside of South Africa, Mauritius is the one that's often used as a good example. And so you become employed by the agency raises invoices to the client somewhere. And actually what that can do is potentially generate a tax-free dividend back into South Africa, and thus reducing a lot of the risk about liability. So any thoughts on agencies there, Jeneen?
Yeah, so this is a very, very good way of structuring your affairs. You must do this before you come, or try to do it before you come, because, you know, you've got to be very careful not to cross the line between, you know, tax planning and tax evasion. And it works very well where you are doing both work in the outside of South Africa and inside South Africa. And the important part is also where your salary your earnings, let me not say salary, your earnings have a sort of a profit element in them, so that one can classify that element as a dividend, and then your income, which should be market related, is your salary or your employment income. So if you've got something like that where one can look at that, and there is maybe earning more than a market related salary for the role that you're doing, that are very good to structure it in this offshore foreign agency. Yeah.
So the message really is there's 7 sort of main scenarios that you can consider. Really, in most of the people on the call, they'll probably be looking at one of these 7 scenarios, and just be mindful of all of the points that we've raised, whichever route you go. And if you're not sure, reach out to us to have a bit of a further discussion. So if we just go through those a little bit more in detail, I know we've touched on some of it already, so we'll wrap through this fairly quickly. But those first 2 examples, so I'm employed, I'm on my own as an employee working for that company, or I'm on my own as a self-employed individual raising invoices, not as a company, but as an individual, then I'm governed by the income tax rules for that jurisdiction. And this is where that gap that you were talking about earlier, this is where this comes from, right, Jeneen? So if we look there at that table, so in the UK, you've got a £12,570 amount that you could earn and pay 0 tax, right? But then in South Africa, everything you earn starts off at 18% effectively.
87,000, yes. So quite a difference. Because let's just say 12,500, let's just times it by 20, that's 251,000. And then if we've got, let's just round it to 87,000 in South Africa tax-free. So you basically got 164,000. And if you're at the top bracket, that's a 5% shortfall. So that you know, that can turn out to be, not just a 5% shortfall, there's no tax on that, which then if you're on the South African bracket, whatever you are, you've got 45% of 160,000 Rand to pay. And that normally catches some people by surprise.
Absolutely. So effectively what you can do here is kind of get a bit of an idea of how much tax you're probably paying in the UK, how much tax you might be paying in South Africa. You can see if there's a bit of a plus or a minus, you know, there might be a positive thing actually potentially. But so that's if you go down, you know, scenario A or B, as we talked about in the previous slide. So in scenarios C and D, so these self-employed contracts, as you mentioned rightly earlier on, you can deduct a little bit more from an expenses perspective. But the message from us really is make sure you do it right. Take advice on it, because if you don't get it right, you could be accruing quite a significant tax bill to whichever revenue you're trying to work with, without realizing that you're doing so. So that's where the advice comes in.
Yeah. So for self-employed, things like, you know, your internet at home, your phone. You can do things like travel and all that, but often people aren't traveling because the employers or the business is overseas, so they're not required to travel in South Africa. But if you were, you know, computers, any kind of office equipment, all those kind of expenses can be deducted. If you're employed, then what you should do is try to get your employer to pay those things, and that's more a reimbursement as opposed to part of the salary. So that you can structure your salary, which helps a little. But you know, as I said before, salary people don't have as much option to deduct expenses.
Yeah, absolutely. So moving on then, thanks for that, Jeneen. Let's look at the corporate route. So now we're getting into scenarios E and F, really, the use of a company. So look, when it comes to company structuring, and you mentioned this earlier, right, that we shouldn't allow the tax tail to wag the dog. So we should be making decisions based on other factors first before we really think about tax. But this is a tax webinar, so we have to present the facts. So the facts are, you know, corporation tax, so what's taxed within that company, and then the dividends tax, the amount you pay to get it out as a dividend, are different between the UK and South Africa. So someone might set up a UK company and think, oh, I'm going to pay 19% corporation tax and a 7.5% dividends tax rate with £2,000 of allowance. But in South Africa, it's 28 and 20. I've included some of the other offshore centres there as well, because often these get thrown in as ideas. You know, to benchmark it. But the three lines at the bottom, really, I think are what we should also not forget. If we're going to set up a company, we're going to use it as our billing vehicle. You know, it needs to be in a safe jurisdiction, right? You know, we need somewhere that, you know, isn't going to suddenly have a change of government or a change of legislation that makes it difficult to operate. You know, we need to be easy to do business with. I think anybody that is in South Africa and is used to dealing with things like exchange control and all the red tape that goes with it will testify to how South Africa is not the most business-friendly jurisdiction in the world. And also it's very challenging to use global or online payment systems, the likes of Stripe, etc. You know, so those kind of things are something to think about. But again, this is where, you know, with only half of the story, people are probably sat there going, oh, well, I'll go and incorporate in the UK or the Isle of Man. And this is where I really want to sort of bring home this point that you mentioned earlier there, Jeneen. So this is the place of effective management or the control of foreign corporations law. So effectively what South Africa will do once you're deemed a South African tax resident is they'll turn around and say, well, yeah, if you paid less tax through that structure, that's fine. We want the balance back into South Africa. Is that right? Am I understanding that correctly?
Sorry, just repeat that for me, Mark.
So the place of effective management. So if we go and set up a company, you fully control it. You're the director. You're pulling all the strings from South Africa. It'd be a deemed controlled foreign company. So
effective management. Yes. So basically, Mark, what you're referring to there is if SARS think that that company is effectively managed from within South Africa, they can claw the company back into the South African tax system and make it register for tax and pay taxes here. So you want to make sure with your offshore companies that you're not, you know, where's your management team based? Where are your decisions made? It's also about substance over form, because obviously, you know, you can sort of fly overseas, which I would obviously suggest if you're going to be running an offshore company and you're making key decisions, you know, you're making those decisions offshore, but SARS can look through that also. So you've got to be so careful with effective management to make sure that the company is not dragged into the South African tax net.
Absolutely. I think, again, that's the message. So, you know, whether you're thinking about self-employed or whether you're thinking about setting up a company, take advice to make sure that you're not creating a trap for yourself. I've had a discussion literally on Monday, and his exact words were, I wish I'd met you 5 years ago, because I think he's had this exact issue happen to him. So there we go. Okay, let's touch on that scenario G now. So this is the one that I think has created a lot of interest. You know, how would a foreign agency work? You know, so we've created a bit of a diagram here that shows how it could work. So Mauritius is the favorite at the moment, really, as an offshore jurisdiction. It's very globally portable, works very nicely. So how this would work is that the agency would employ you if you're a contractor, a skilled contractor, do a back-to-back arrangement with your client, and then raise invoices for the services as the contractor. That's the orange line there. Say it's in the UK, it might be somewhere else. And then those invoices are paid to the Mauritian company, the agency in this example. What that allows you to do then is to then pull money back to yourself in a number of ways. The first one obviously is as you said, a market salary. Yeah, that would still be fully taxable. But like you say, if there is a residue that's left over, so an amount over the market rate, then effectively you might be able to bring that into South Africa as a tax-free dividend using what's called the foreign participation exemption. Alternatively, you can then use it to fund the likes of an offshore pension investment or an offshore property investment. Some great solutions out there for that. One of the questions I've seen just pop up in the Q&A actually is just a slight nod here to the 1.25 million rand exemption for foreign workers. This is section 10.10 of the Income Tax Act, and not to be confused for everyone, this only applies if you're out of the country for at least 6 months of the year, right, Jeneen? So you have to do at least 100 days out of the country, 63 of them consecutively. So only then would you get that exemption on your tax. So if you're not, so if you're in the country all the time, no, you wouldn't get access to that. So hopefully that answers that question. Any thoughts on that agency solution? Seems quite a neat way of doing it.
Yeah, it's a neat way of doing it, Mark, and I've seen it working now with quite a few people. So I definitely think that if you're a very high earner, this is an option to consider. And you obviously need to take advice. Every situation is different, but it's a good structure.
Yeah. Okay. Fantastic. Okay. Moving on then. Just a little note about UK pensions. So this is really from my side of regularly advising on UK pensions and qualified to do so down here in South Africa. So one of the things you need to be aware of is workplace UK pensions should only be contributed to when you're physically present in the UK if you want to get tax relief on that contribution. Once you're an overseas resident, the maximum that you can contribute in each year is £3,600, so £300 a month. So what you might find, or you might be thinking about as a digital nomad, is try and remain on the UK payroll for a period of time. But the challenge that creates is that the PAYE system may not be able to contribute to your pension, or it might flag up an issue that you're no longer physically present. I've seen that happen once or twice before. It also then potentially creates a problem in the future. So this is something to be made aware of, is that any contributions you make into a UK workplace pension, as an example, or a foreign pension that you're going to be using that was employed pension money, when you come to draw that money out, those contributions that you've made directly to it when you're in South Africa won't get the 0% exemption that I talked about at the beginning. So it can muddy the waters slightly. So again, just think about it and get some advice before you sort of dive into that, or think that that's an easy solution. So then the question obviously is, well, how do I plan for my future? How do I, if I'm going to go and work as a contractor, or I'm going to work in an agency arrangement or whatever it is, how do I make sure I am planning for my future responsibly? So one of the things that's an alternative to a UK pension vehicle is some very good offshore equivalents. So by offshore, it's predominantly in the places like the Isle of Man and the Channel Islands and what have you. What does it mean in a nutshell? It means that you could potentially contribute in and then draw out a very tax efficient amount in the future, but that's on a case-by-case basis. You've got full range of access to global investments, but the best bit really is no restrictions. Okay, so in South Africa, the retirement annuity system here is quite dated. 1/3 you can take out as cash, but then the other 2/3 has to go into an annuity to provide ongoing income. It's quite an expensive system, and there are other alternatives outside of the country that don't have any of those kind of restrictions. So just ask the question before going down that road. And one of the big questions really is, will the rand continue to depreciate as it has done for decades? I mean, I literally was having this conversation with a client this week. 10 years ago, it was 10 rands to the pound. If you bought money down there and bought a house, it's effectively halved in value to where we are now at 20 rands to the pound. So my question is, if you bought a place in South Africa 10 years ago, has it doubled in value in that 10-year period? And unfortunately, probably hasn't, because of the challenges, post-COVID in the property market, as an example. But meanwhile, the UK property market has just kept going up and up and up and up. So actually, the sort of cost of selling out of an investment property in the UK and buying in South Africa can mean that over a 10-year period, you might only have the equivalent of 30 or 40%, maybe 25% of the worst case scenario of what you started with. And I see this quite often, where expats can't afford to buy back the investment properties that they used to have, and so they might be rand rich, but they're becoming primary currency poor. So that's again just a note. And so one of the things to think about is how to use things like investment property and UK buy-to-let mortgages to grow your wealth in that regard. But anyway, that's something we can assist with. Let's come back to the subject at hand, which is how to get these sort of arrangements structured. So just a little reminder that unfortunately we can't give advice, specific advice in this public forum. So nothing that we've done here is to be construed as advice. We always recommend you take advice on an individual basis, just to understand a little bit more about what your options are. So we're going to move on to the Q&A session now. And we've got quite a lot of questions already coming in. So we'll move on to those now. So Jeneen, let me just sort of pick one of these here that I think we might be able to answer. And apologies, ladies and gentlemen, we're not going to be able to answer everything because, like I say, it's just straight into the sort of advice territory. So we'll do the best that we can. So I'm just going to start off with this one. So we've got some Australia questions here at the top. So Jeneen, let's start with that one. Is there a dual tax agreement with Australia?
There is.
Okay.
Yeah.
Okay.
If this person wants to reach out to me, I'll send them a copy of that.
Okay, brilliant.
Yeah.
And that's fair to say most countries around the world there will be a dual tax agreement with.
Yeah, we've got about 70. I think it's about 70. Pretty much. Yeah, most countries, as you say.
Yeah, most of the ones that we certainly deal with and see people coming back from on a regular basis. Okay. All right. So moving on then, how does one test one's view of their residency status to ensure SARS has the same view? I assume I'm not resident until 183 days, yet further down the line, SARS sends me a bill as they have seen me not to be a resident when I arrived in South Africa. That's a really tricky question to answer.
Yeah, that's a good question. So you say, this person says, I assume I'm not a resident until 183 days. And that actually speaks to that first comment that I made. In fact, if you come here and you end up staying more than 183 days, you've got to be careful because you are now tainting not necessarily tainting your residency, but you're certainly making that income that you earned in that 183 days taxable, whether you were resident or you weren't. But basically, SARS will ask, if SARS were testing your residency, they will ask a lot of questions like, where do you have your primary home? Where's your work? Where are your family? Where is your life set up? Do you go to the gym? Have you joined a church? All these sort of very obvious things, but they point to where your life is. And that's how SARS will test your residency. That's the ordinarily resident concept. And then, of course, the other is the counting days. So, and that's calculated as Mark's got on those slides over a period of 6 years, basically.
Okay, and so just a reminder, we were launching polls just to help us understand, what the feeling is like out there on the question. So if you get a chance, please just answer the questions that are in the polls now, and we'll share the results at the end of the Q&A session. So thank you very much for that one, Jeneen. And moving on, sorry, we just answered that one. How will my UK employer know if they should deduct South African PAYE or HMRC tax? What if they incorrectly pay tax to an authority without understanding my personal situation or SARS expectations? So this is a great question. This is that scenario A that we talked about.
Yes.
Long story short, the employer won't make any differences, will they? It's a UK PAYE system. It will deduct tax as though you're a UK citizen, and then it's your responsibility to do anything that you need to with SARS, unless. Go for it.
So this is where the employers can get liability, because in fact what could be happening is they could be setting up an office here, and I do see that with some foreign companies. They start getting more than one employee, and as soon as they meet the definition of having a representative employee, they have an obligation under the South African Income Tax Act to withhold PAYE and pay it over. So basically the short answer is they need to seek advice as to whether they do have a PAYE liability. And then of course make sure that they're not double deducting, as in also deducting in the UK. So again, advice in the UK about whether they should be deducting for that individual person. Yeah, that's the answer really. But they can attract a tax here.
Yeah. Okay. Fantastic. We've got a number of other questions, so we're going to try and do our best to answer them all. I think we've covered this one about the 1.25 million rand, not to be confused. It's an expat tax if you're non-physically present in South Africa, but effectively a rotation worker. So we brush up against this a lot with our oil and gas industry clients, the guys and girls working on rigs.
Yeah, so maybe I should just explain quickly, recap on that one quickly. So Section 1010 is only for South African tax residents. That's the first thing to note. Secondly, you have to be an employee. It doesn't apply to independent contractors, and that there's always a little bit of grayness in the contracts, because sometimes they're not actually employment contracts, so you can get a little bit of problems around that. And then, of course, you have to spend this 183 days outside of South Africa, and you have to have a block of 60 days. And then it's important to note that only the first 1.25 million of your income whilst you're working outside South Africa is tax-free under that Section 1010. And there's a few other nuances if you're working on ships and things like that, that they don't have the 1.25 million cap. The income is averaged over the period. So there's a few things that you've got to be aware of, but that's it in basic terms.
Okay, fantastic. Okay, a few other questions, and we'll try and wrap this up fairly soon. Sorry that we can't get around to all of the questions. We're going to just go through the poll before the end as well. So a question here from Chris on the pension question: what about national insurance? Should we continue to make a minimum contribution even if living abroad to make sure we keep the state pension? I'll handle that one. So one of the things about the UK pension system is the state pension, not to be confused with private workplace pensions. Okay, you have to have contributed for a minimum of 10 years now to get anything, and you need a full 35 years of contributions if you want to get the full state. Oh, sorry, hang on, my laptop's just about to die there. So if you want to get this full entitlement, you need to have contributed for 35 years. You can buy back additional years. So once you've moved out of the UK, you can buy additional years. It costs about £750 a year. So there's a bit of a netting off discussion to be had there, and it's something that I would advise that you're doing in conjunction with a qualified financial advisor that's cross-border, obviously like myself. Based on the source income scenario, this is the next question, where I plan to be an SA for an undetermined time. Does it make sense to use the offshore agency? My employer has told me I have still been paid into a UK account in pounds. How would that work with an offshore agency? Well, I think we can maybe sort of come back to the scenarios, the best way of clarifying this. So clearly you're not an employee, so you're not in an A or B scenario. You've crossed that dotted line, you're now into C or D. So yeah, you're pretty much in scenario C. You're going to be a self-employed contractor. So, you have to declare your income to an authority. That might be HMRC if you're going back, or it's probably going to end up being SARS by the way you're describing it. So just be mindful of the fact that that will be deemed income, and worldwide income is within the purview of SARS, regardless of its pounds.
So what I would say here, Mark, is that for this person, depending on the amount of their income, their salary, they could go through a foreign agency. And it doesn't matter where the money is paid. From a South African perspective, it's a case of where you're working that determines your tax liability in South Africa. So you can still get paid into your UK bank account. That's not a problem. And if, of course, you take a portion of your income as a dividend, and I saw another question in pop-up below, if you own more than 10% of the shares in the company, that dividend is tax-free, that foreign dividend is tax-free in South Africa. So that's the foreign agency concept that we're talking about.
Absolutely, but it's something to be really mindful of here. And again, I've seen people trying to do this and not quite getting it right, because there's a lot of well-established legislation, isn't there? So, if you try and create a company and you are effectively controlling all the management decisions are being made in South Africa, there could be an argument it's a connected party. Yes. If you're using some kind of a trust vehicle, so it's at arm's length, then maybe you can argue the other way. But there's that sort of Goldilocks spot, isn't there? Above 10%, around about the 20% mark. But again, that's really specific advice. So if you're thinking about you want to set up your own company, effectively mirroring like that agency arrangement, but you want to control it all and maybe create some kind of billing vehicle or investment vehicle. I've seen that done a few times before, and that's something I'd highly recommend you only do with really solid, strong advice. Anything you want to add on that one?
Yes, yeah. So Mark, if you're going to end up controlling via shares or voting rights a foreign company, so what we mean by that is owning more than 50% of the shares, you're not going to achieve anything, because basically the profits of that company should be included in your South African tax return. That's called a controlled foreign company. Now, there are some exclusions to that. That is, if that company has a proper permanent establishment, or let's say a proper office with employees and business rights in the country that it works in. So it's not just something to save tax. And the other exemption is if the tax rates are quite similar to South Africa's, then you find you're not going to have to include the profits in the South African tax return. So it's a complicated area. So do be careful. It's only where your company is held by a trust or something like that, a similar concept, that you're going to be outside of the controlled foreign company rules. Also, as Mark, you said, be careful that it's not effectively managed from within South Africa, in which case it could be pulled into the South African tax net anyway.
Yeah, absolutely. And I'm really sorry we can't answer any more questions. I mean, we've just got stacks of them coming in now. Just very quickly, yes, Jeneen, but my understanding is that you can bill anywhere in the world. So pounds, yes. Euros, Swiss francs, yes. Dollars, using an agency arrangement, it's all fine. So a bit of a shameless plug from us. If you found today useful, obviously we do these free of charge. Janeen's given up her time free, as have I, to try and help the community. So please leave us a review on our Facebook page. You'll find it under UK Expat IFA. And just a reminder of the little video that we had at the beginning. We are raising money for the African Impact Foundation. So if you're able to donate anything at all, any small amount whatsoever makes every bit of a difference. So I've just sent a link in the chat. So if you don't mind, a small donation to African Impact Foundation as part of our chosen charity for the year, it will make a huge impact. So thank you for that. So we're going to just wrap up talking about the polls here. So some really interesting data. 82% of the people that are on the call today, aren't a digital nomad or a remote worker, but they're thinking about it. So, obviously this is becoming very, very active. It's something that everyone's thinking about that's on the call, which is great. The vast majority, so 40%, are still overseas and outside of South Africa. So again, showing that there is a need for people wanting to find out this information. And actually, nearly 50% of the people that are here today are saying, crikey, I think maybe it's made them open their eyes that they need some help. So that's where myself and Jeneen can assist you. So feel free to reach out to us. We'll touch base with everybody after this anyway, and just see if there's anything we can specifically help with them. Hopefully it's been useful. Thank you very much, Jeneen. As always, really, really valuable. Thank you for your time.
And your pleasure, Mark. Thank you so much for hosting.
Okay, and thank you everyone for joining. I hope it's been useful. Take care. All the best.